Good afternoon and welcome to our webinar today on overcoming challenging debtors. My name is Sam Hawkins. I'm a manager in our restructuring team and I'm joined by colleagues across various service lines in Bishop Fleming to look at this tricky subject facing businesses of all sizes. It's not really possible in 2021 to hold any kind of webinar or event without mentioning COVID, so let's get out of the way at the outset. During the pandemic, there have been various restrictions on individuals and businesses, affecting their ability to trade, as well as that of their customers and suppliers. Along with the impact of Brexit, we are finding the economy to be in an unusual place at the moment. The one thing, however, that remains true, especially in troubling times, is that cash is king. Cash enables businesses to invest, grow, pay their suppliers and employees, and therefore enables ongoing trade. This is true for all businesses throughout the supply chain, and so all parties will be looking to preserve their cash. With the lifting of restrictions, the government have also begun to remove support schemes that are available to businesses. We have already seen the end of the furlough scheme at the end of September, as well as the return of statutory demands and winding up petitions without the need to set out how the debtor company has been impacted by the pandemic. The relaxation of this requirement has opened up the tools available to you, but also to other businesses. When customers only have limited funds available, it is always better to be at the front of the queue. Often in service line professions or when your customers are other businesses, it is necessary and expected to offer credit terms. Many businesses are finding that as the confidence returns, their order books are strong and they have a very few busy months ahead of them. Great news. The challenge is, however, ensuring once you've done the work, how do you actually get paid for it? The aim of today's webinar is to provide you with the tools necessary to ensure that you have the best chance to collect what is due to you, stop good money being thrown after bad, and ultimately what options are available to you. Initially, Hazel, a partner in our corporate and business services team, will discuss what businesses can do on a day-to-day basis to monitor their debtor ledger, why this is important, including the impact this can have on your working capital. Sometimes, whilst credit terms are the norm in the industry, it's not possible until the debt is actually payable and you receive the cash. Jamie, a manager in our corporate finance team, will discuss how businesses can look to finance their debtor ledger. And for the vast majority of cases, these two scenarios will cover everything for you. But what happens when it doesn't go right? What can be done? How can you ensure that your time and money are spent appropriately? Luke, a director in our restructuring team, will introduce you to our partnership with Escalate, an innovative, low-cost option enabling legal action to be taken against troublesome debtors. Whilst in essence, Luke will cover what happens when your debtor won't pay. What can you do if your debtor can't pay? Jack, a senior manager in our restructuring team, will look at the options available to you. What can you do to provide the best opportunity to recover money due to you? And throughout this webinar today, you'll see a box on your screen enabling you to ask any questions you have during the webinar. We do have time to host a Q&A session at the end. And I will now hand over to Hazel. Thank you.
Thanks, Sam. Credit control is a system used by businesses to make certain that it gives credit only to customers who are able to pay and that customers pay on time. It is a critical part of a well-managed business that will help to mitigate bad debt risk exposure and assist with effective working capital cash flow management. It's human nature that many customers will not pay their debts until they are prompted to do so. Many will often defer settling their liabilities for as long as they can quite frankly get away with to manage their own cash flow needs. With fewer than 50% of invoices being paid on time and bad debt and cash flow issues cited as two of the main reasons of business failure, it's vital that someone senior within the business has overall responsibility for monitoring and managing this important aspect of the finance function. Improving the management of your debtor lockup will release important cash flow into your business and can help to avoid the need to raise external finance and incurring unnecessary interest costs. Having cash funds to make payments on time to suppliers will also help to improve the business's own credit rating. The debtors day ratio measures how quickly it takes your debtors to pay you. The longer it takes for a company to get paid, the greater the number of debtor days. If you have credit terms of 30 days and your debtor days are, say, 60, that means it takes twice as long for debtors to pay you, as it should. And the larger number of debtor days means that a business must invest more cash in its unpaid debtors asset that locks up working capital. By way of an example, for a £2 million turnover business with debtor days of 90 days, has £500,000 worth of cash tied up in their debtor book at any one time. If this was reduced to, say, 60 days, by taking some simple actions, such as chasing for the collection of debtors the day they become due, and immediately sending invoices as soon as the goods or services have been delivered, rather than waiting to a month-end process to dispatch them, this would release a third of the £500,000 debt, effectively freeing up £167,000 worth of cash into the business. These really are simple actions with such a big impact on cash flow. The key to good credit control is having a clear process in place to manage debts, with an agreed and documented policy of procedures and responsibilities on when and how to chase up the collection of debt and the appropriate timing of the legal and debt recovery escalation process. Regular monitoring of your financial performance is vital to keeping business finances in check, and a big part of maintaining this health is keeping a very close eye on debts and overdue customer accounts. Good debt management begins with routinely tracking debt aging profiles. It is useful to check that your accounting software system is set up to show late invoices and aged debts in an accessible dashboard format. An effective credit control function should be consistent with regular actions and ongoing follow-up. Bank accounts should be routinely reconciled so that monies received are promptly allocated to customer accounts to enable the credit controller to successfully perform their duties. It is really important to keep a regular check on the increased debt levels so critical red flags are not ignored. Checking aged debts as often as possible and building these reviews into your regular finance cycle will facilitate proactive action to quickly chase for payment, allowing accounts to be put on stop promptly if considered appropriate. Highlighting regular offenders to track who's paying well and who's frequently late. If a customer is constantly late, do question whether it's profitable to carry on working with them. Good credit control is based on building relationships with customers and creating a rapport with them. Be firm but polite with chasing. Whilst 80% of unpaid invoices can be collected through email reminders alone, for the remaining 20%, a phone conversation will be more appropriate. Customers find it harder to justify late payment when you have them physically on the line. And if there are issues to resolve, you can discuss with them in real time instead of spending further days with back and forth email exchanges. Really understanding your customer's circumstances enables greater flexibility to agree a payment schedule. Late payment might be the finance team's responsibility, but other members of the team are equally important and can help too. Credit controllers work closely together with sales staff and account managers when their customers' accounts are overdue, as they often might be able to help leverage their relationship to get an invoice paid. Gaining knowledge of your customers' processes and approval systems when it comes to invoicing is also a useful factor to ensure that invoices are in the correct format to avoid delays in late payment. For all new customers, it is worthwhile asking these practical questions. Who do I talk to about invoices getting paid? What information has to go on the invoice for it to get paid? When do you do your payment runs? With this information to hand, you will never waste time sending invoices that cannot be paid or chasing the wrong person when it becomes overdue. Working these procedures into your monthly financial cycle and building your debt figures into your key performance measures is a good way to stop debt becoming an issue. A credit management strategy can also help to minimise credit risk. It involves much more than reminding customers to pay. The most successful strategies assess the creditworthiness of potential and existing customers to be aware of any signs of them being in financial distress and allowing you to manage any risk by adjusting credit terms. This also looks at potential changes to the political or legal environment and future steps to reduce risk. We consider it would be good practice to assess your customer's credit rating. Does this meet your predefined conditions? Ensure that contracts include your terms and conditions and details such as exit period should you wish to cease trading with them. Monitor your customers continuously, including those that you have been trading with for some time, including obtaining their latest financials. Taking steps to terminate relationships once a customer no longer meets your conditions. Gaining knowledge of your customers' processes and approval systems when it comes to invoicing is really important to help ensure that the invoices are in a correct format to avoid delays in payment. We are advising many businesses on automated credit control systems and processes with it, which allows businesses to get real control over aged debtors, with the tools needed to streamline and automate their debtor tape process by linking debtor management tools to the financial data in the accounting software provides real-time data to all sent invoices, late paying customers, plus a holistic overview of the whole aged debt process. The processes that can be systemised include email reminders, phone call actions and statement runs, which can automatically be scheduled, enabling the credit controller to be more proactive in chasing a higher volume of problematic debts. With artificial intelligence and machine learning helping to highlight the debts that should be chased and flagging those who promised to pay, credit control is definitely smarter and more effective. If you are really worried about credit risk, it is also worth considering whether to mitigate this and protect the debtors with credit insurance. Please do not hesitate to contact a friendly Bishop Fleming advisor if you have any questions or would like to discuss our outsourced credit control services. I asked Bishop Fleming's wonderful credit controller, Iris Moon, for one takeaway piece of advice for today's session, and her response was, keep on top of the collection of debt and resolve issues and disputes promptly. Thanks, Iris. I'm now going to hand you over to Jamie Pilmer, who is going to discuss financing your debtor book.
Thanks, Hazel. That was really quite insightful, I think. Thanks for that. So as Hazel was saying, my name is Jamie. I'm a manager here in the corporate finance team at Bishop Fleming, and part of my role is to help businesses raise finance. Form of finance that's often overlooked is invoice financing. So this type of funding uses your debtor book as security, allowing the business to accelerate its cash collection from sales invoices. So there's various kind of names and subcategories of invoice financing. You may have heard of debt financing or invoice discounting and so on. They've all got specific niches and purposes, but fundamentally it's the process of borrowing cash from a funder using the value of your debtor book as security. So the aim here is to accelerate the cash collection process from customers, and instead of relying on them paying you in credit terms or beyond credit terms, as can be quite common, you can draw down funding from a finance facility almost immediately after raising a sales invoices. So this is why it's also quite helpful for growing businesses, because clearly as a business grows, its working capital need continues to climb with it. So you don't need to wait for cash here. You can use the cash recovered from the financing facility to immediately invest back into purchases or paying historic other liabilities. Beyond that as well, because this is an asset focused or asset backed form of finance, and hopefully your debtor book's relatively liquid, invoice financing can also be significantly cheaper than maybe using a bank overdraft or other forms of unsecured lending. So in terms of how it works then, so typically you'll provide goods and services to your customers and invoice them as normal. That doesn't change. But then you'll notify the invoice finance provider of the sale. So nowadays that's just done through an online portal 9 times out of 10. Then you can draw down from that facility a percentage of the face value of the invoice. Different funders will have their own view on that percentage, and that'll just be down to their assessment of risk within your debtor book. On average, we tend to see around 80% of the face value of invoices. There's also some specific things to think about. So, for example, funder may consider there may be some sales invoices that would be disallowable, i.e. they wouldn't want to lend against. These could be debtors, as a couple of examples, they could be debtors outside of normal credit terms. There may be high customer concentration within your business. The reason that becomes an issue is all of a sudden, if there's an issue with an old debt or there's an issue with a single large customer, that starts to blow holes in the bank's security. So clearly they wouldn't like that. I think really this means that access to cash has to be access to invoice financing to keep on top of your debtors. You just need to be really tight with how you do it, basically, because strong credit control procedures are critical. Just to ensuring you get both the best financing package. Well, there's two things really. One is maximising the proportion that the funder's willing to lend, and also improve the rate, but also then better practice, like Hazel was describing, will also allow you to access that cash as quickly as possible. So another form of financing that's starting to become more prevalent is spot invoice discounting. So this is where you would be invoicing specific invoices, financing specific invoices only. And this might be more relevant if you're maybe changing credit terms on a certain account, or maybe you are taking on a new customer. Just as a couple of examples, it just basically means you don't have to open up your entire debtor book. So now we know roughly kind of what invoice financing is and how it works. How do you know if it's the right fit for your business? Well, kind of generally speaking, it is suitable for most businesses. There's obviously a couple of key exceptions, and any business with a standard debtor cycle should be suitable. Just bear in mind that obviously the higher risk your debtor book, so we're talking about what we were talking about earlier, really. So, you know, high customer concentration, talking about, long credit terms, or maybe a track record of bad debt. It all becomes, what it tends to do is increase the cost of funding potentially, or it might even make it difficult to get funding in the first place. One specific case where it can be a problem as well is like something like where you're not invoicing maybe the final goods or service. So an example, this might be maybe the construction industry. So, you know, stage payments and invoices are being raised as the project commences. But if there's a long contract that lasts for quite a while, there could be a problem in a year or two's time on an invoice we're raising now. And clearly, if that arises, that the funder's going to get a little bit unconfident with security, given that it's all based on the debtor book. So in that case, it's less likely that the financing product would work there. In terms of how you actually get invoice financing, to be honest, it's just offered by nearly all mainstream banks. There's also a wide range of alternative funders as well, some of which are specifically focused on invoice financing. Usually you would submit an application like any other funding product. This can be done, you know, if you're using your main bank through a relationship manager, a normal funding approach really. So you would explain the rationale behind the funding need, support that with management accounts, stat accounts, maybe a forecast. Your accountant should be able to help you with all of that. And here at Bishop Fleming as well, we also use something called Capitalise. You may have heard of that. This is basically a platform which has access to over 100 lenders. We would work with you on an application into that platform. That would then get sent off to all these lenders and you'd start to receive offers. So we would help you choose the best one out of those. And just something else to consider as well, alongside invoice financing, it's often offered as part of a wider asset-backed financing package. So this might also include stock finance, maybe property-backed lending, or plant and machinery funding, or whatever is most appropriate to the business. Basically, what the aim there is, it's trying to achieve the most flexible financing package possible, really. So the business should win because it's unable to generate the cash it needs when it needs it, and then also clear off those debts when it doesn't in a flexible way. But also the lender wins because they're able to lend in the first place, but also they are kind of securing against specific assets, which enables them to lend on more favourable terms because their risk profile is lower. So there's quite a lot to think about there, but that's been a bit of a whistle-stop tour of invoice financing. Hope you found that helpful and have been a bit of an insight. Yeah, I'll now hand over to Luke, just to discuss how we can help you collect those tricky debts. Over to Luke.
Thank you, Jamie, and good afternoon, everybody. So tricky debts. We've heard about credit control functions. We've heard about funding ledgers. But what happens if you can't get money out of your customers? So we're talking about here, those customers who they're not going to pay you rather than they can't pay you. Perhaps they're not engaging, or perhaps they're just coming up with some sort of spurious dispute as to why they're not going to pay you. But either way, you can't get money out of them. So you might have your own credit control function, going back to what Hazel was talking about, and you'll chase the debts. And it might be that you then refer them on to a debt collection agency who would do the same for you on probably a no-win, no-fee basis. There are firms out there who will sort of operate on a sort of 10 to 15% commission rate. They will churn out some letters, but if they have no luck, you will then probably need to instruct lawyers, which will attract additional costs. You may have to pay court fees, and you may also have to get counsel involved to give you that additional support as well, depending on the sort of size of the claim. So it becomes more costly, and it becomes more protracted as well. And I think it's probably for these reasons that only 11% of businesses actually pursue perfectly good debts, which probably seems very low. And that also helps to explain why the more than £40 billion is actually locked up in unresolved disputes every year. So some pretty big numbers. And obviously this is, it's a massive drain for businesses who have ultimately provided a perfectly good product or a perfectly good service that they just haven't been paid for. So what can we do to try and tackle these tricky debts? Well, there's a business named Escalate Disputes that was created by 3 long-standing professional service firms, and their aim was to help businesses tackle these debts, whether it's a straightforward debt or a more complicated commercial dispute. So it's a new solution. How does it work? Well, you get an initial advice free of charge. They'll look at the merits of the case, they'll look at the sort of credit worthiness of the other side, and they'll give you advice as to whether or not, firstly, you've got a good case, and then secondly, whether or not they can run it for you. If that's ultimately negative, at the very least you're getting a free sort of legal opinion. But if it's if it's good advice, if it works, then Escalate will run the case for you. And that process starts with initial sort of negotiation. So the premise around Escalate is all about trying to do a deal to avoid going to court, avoid protraction, and avoid incurring lots of costs. If they can get the other side to the table, fantastic. Let's try and do a deal. But a lot of the time people are entrenched and it's not possible to do a deal. So it will then flip into the normal sort of legal route. But it is different, okay? Because firstly, all of the costs are contingent on success. So Escalate will fund lawyers' fees, they'll fund counsel's costs, they'll fund court fees, and they'll even fund expert fees as well if you need to get a quantity surveyor involved, for example. So they'll fund all of that, and those costs are recoverable if there is a successful outcome at the end of it. If there isn't a successful outcome, then there is absolutely no cost exposure on your part. So it's great from a cost point of view. They also build an adverse cost assurance into the service. So if ordinarily you go to court and you lose, you will have to pick up the other side's costs. With Escalate, it's different. There is the insurance. So if you lose, you're not on the hook for their costs. It's funded by the insurers ultimately. So from a risk point of view, it's a really good option. The Escalate service extends to actually getting cash. So it's not just about going to court and getting a judgment. It's about getting cash into your pocket, which I think is very important. Going back to Sam's comment about cash is king. So they take it all the way. They get cash into your pocket if they're successful. There's no risk. Another real benefit here is that I think all of the interests are aligned because the insurer, the funder, and the lawyer, they're all working under the same roof. So everybody's sort of working, together as a team with one sort of common goal. So it's a very good package. In terms of what they'll look at, well, they'll look at pretty much anything from sort of straightforward bad debts from £1,000 upwards to the more sort of complex, commercial dispute type issues that lots of businesses see, perhaps once every 3 years, but they can be the real difference between a business continuing and a business unfortunately not continuing. So they can look at pretty much anything. And in terms of track record, they've helped businesses recover. I think it's just in excess of £100 million to date. So they've got a very good track record. And like I said, that's from the simple stuff all the way up to the multi-million-pound stuff. And we, within restructuring and within the wider firm across Bishop Fleming, we've seen firsthand the really good work that Escalate do. So if you've exhausted your credit control procedures and you need help recovering a debt, or you need help recovering or resolving, like I said, a more complex sort of wider commercial dispute, then we'd be really pleased to help you with that. And it might be the case that Escalate isn't necessarily the answer for absolutely everything. It's fair to say that we work very closely with lots of different law firms, and the circumstances surrounding claims and the circumstances surrounding the claims will always differ. But if the common barriers present, going back to the initial facts that I pointed out, if the common barriers present around, can I afford to take this all the way? What is my appetite for risk? Do I want to accept adverse cost risk? If the answers to both of those points are that you've got an issue, you need help, then Escalate is likely to be a really good option for you. So there you go. We'd be really pleased to talk to you about it if you've got any of these sorts of issues. That's me done. Thank you very much. I will now hand over to Jack, who will talk about the can't pays. Thank you.
Thank you, Luke. Good afternoon, everybody. Quick shout out for the old Q&A box, if I may. That was just the one question in there looking a little bit lonely, so feel free to give it some company. Although I see that the Escalate topic has slightly escalated things, my sincere apologies for that. Thank you for joining us. As mentioned, I'm Jack Callow and I work within the restructuring team here at Bishop Fleming. So we're going to spend a couple of minutes now exploring a strategy which looks to reduce the risk of bad debt in your customer base in circumstances where your customers simply cannot pay you. Now, for me, the word creditor carries a certain negative stigma. When you look at a balance sheet, for example, all the value is at the top in the assets. And as you gaze further down and your eyes start hitting liabilities, you start to see what's diminishing that value. When a balance sheet is broken up, the situation just tends to get worse. Asset values deteriorate and the liabilities position crystallize, often seeing the total debt go up. And the creditors, well, they're left to pick up the tab. Whether it is the diminisher of value or the loss sufferer, the role of a creditor is rarely a pretty one. It is worth remembering then that for every customer you have within your debtor value, you are playing the role of creditor in their balance sheet. It is of great value to any creditor then to take all steps possible to get paid on time and without default. The starting point is relationships. Where it is possible to build a relationship, time and effort should be taken to do so, because the better your relationship is with a customer, the greater your chance is of having honest communication with them. The greater your prospects are of them listening to you, the greater your chances are of spotting changes in their behaviour. When a customer struggles, whether it is suddenly, sporadically, or over a longer period of time, there is no guarantee that that customer will take the most appropriate course of action. That doesn't mean they're bad or incompetent. It's more likely to mean they haven't seen the issues or refuse to accept them. They might be following a strategy that they believe will see their business through and are executing it unchallenged. They might not know that advice is available to support them. If you have a relationship with a customer and you spot a change in their behaviour, that is the time to act. If, say, credit control or the wider finance team spots a change in a customer's payment behaviour and they notify the relationship holder and they have a relationship with us, you have now ticked 3 critical boxes. You've spotted the issue, you've got a route to a conversation with the customer, and you have help on hand if it's needed. Our purpose is to help your customers tackle their problems so that they not only cease to be your problem, but they go on to continue to add value to your business. Precisely when we are needed has to be on a case-by-case basis. But by talking to us regularly about the issues in your customer base, we will build up a relationship that will lead to us exploring with you how to help your customers. When we can access your customers' proposals, we can assess your general position. Sorry, allow me to start that again because I got. We can assess your customers' proposals, we can assess your general position, and we can advise your customer on their route back to being able to pay you. Now, changes in payment behaviour really is crucial. I spoke with a client recently who was very unfortunate to suffer a customer going into insolvency. That client told me he wasn't surprised, to which when I asked why, they simply commented, "You always know when someone is going down because they stop paying you." We want to avoid that scenario by advising early enough to prevent payment stopping altogether. So what do we mean by changes in behaviour? Well, in non-exhaustive terms, because any change could be relevant, we're talking late payment when payment is normally on time, or later payment if they're always late. Payments of random amounts or lump sums, chasing of orders, changes in tones of emails, frequencies of communications. Even if the change appears positive, like placing far greater quantities of orders, understanding the reason for that change will put you in the best position to protect against any threat to your business. Now, there are always going to be situations where you have a challenging debtor, you have a relationship, but communication is not happening as you would like. This could be suspicion of dishonesty, omission, or just no communication at all. This is where legal action could be relevant, just as in the won't pay cases. Where customers can't pay you, there will always be a pinch point between where creditors are being paid and when payments cease altogether. We will never know the precise timing, but legal action can be used to force you to the front of the queue and be one of the last creditors paid. This is not a tactic of the customers. They are just simply trying to survive as long as possible. Legal action is a real threat to that, so creditors taking this action can get greater attention. Of course, there is a cost to this, and any steps should be considered carefully, but we are again available to discuss strategy with you. There will also always be customers that you have less of a relationship with, or indeed have no relationship at all. Now, the advice has to be to change that, but relationship or not, your customers can become insolvent. It's just the ones you know less well, which are the ones that often surprise you. We can explore with you the impact on your business and use our skills to ensure your business continuity, just as we would have done with your customer. Whether you are familiar with insolvency processes or not, and the forms you receive as a creditor, it is still worth reaching out to us to talk through what has happened and what the outcome of the process might be. Again, immediate action is advisable. The paperwork you receive may contain details of what is called a decision procedure. You will have a vote in that decision, and if your debt is large, your vote could well be substantial. We can help you make sure your vote is used effectively. Make sure you get your claim forms submitted. Get your evidence in at the same time so it's done, and keep track of your claim somewhere. Hopefully, you won't have many. But changes of address and or contact details can make it very difficult to get dividend payments out to you. Finally, and to summarise, the risk of a customer not being able to pay you will be more visible to you the stronger your relationship is with that customer. Your chances of keeping that customer are greatly improved if you tick 3 boxes. Identify change early, reach out, take advice. We can work with you and your customers using our turnaround and business improvement skills to address their problems, because repositioning your customer's business is the best prospect of your debt being paid. Thank you. I'll now pass back to Sam.
Thank you, Jack. We've had a few questions in, which we'll go through, but as I say before, if anything pops into your head in the meanwhile, please feel free to drop a question in our question box. The first one we have is, how do you assess a customer's credit rating? And I'll hand over to Hazel for that one, please.
Thanks, Sam. Well, there are a number of things that a business can do to assess a customer's rating. First, you can look at what information is readily available in the public domain by going to Companies House and looking at the latest financial accounts. Assess whether they are filed on time or whether they're overdue, and the position of the balance sheet and the overall trading position. So that would be a good starting point. The second is if it's a new customer, you could actually reach out and get references from their other suppliers that they use, just to get some comfort that the business is good for their money and they pay those other suppliers on time. And then one other option is to actually look at using third-party agencies to assess the credit health score of businesses. And you can do that through organisations such as Experian. And that also evaluates the external information that's available in the public domain, but also considers things like the sector that people in and whether it's a risky sector, whether the business has had any county court proceedings filed against them, whether they have had some late payments with suppliers. And basically, it gives you an overall score on the health of that business. There are ways that businesses can actually improve that, but that's another conversation for another day. So if anybody's interested, yes, you can sign up to get health score reports from third parties such as Experian.
Thank you, Hazel. We've had another question come in. What is the time frame for resolving an escalate case? Luke, please.
What's the time frame? So it very much depends on the case in question. The focus is very much on trying to get the other side to the table. It's all about trying to get the early deal, and that's over, I'd probably say, a sort of initial 3-month period. The bit before that, in terms of you getting your advice on the merits of the case, is actually done quite quickly, and you'll get your advice within sort of 2 or 3 days. If that initial sort of 3-month period doesn't yield a positive result, then it will flip into the the normal sort of legal procedure in terms of issuing particulars of claims, disclosure, trial, all that sort of stuff, and that is very much dictated by the legal process and court availability, that sort of thing. So I think unfortunately it's difficult to give an accurate idea of time, but the message is very much about trying to get this early settlement, and certainly pushing for that if at all possible.
Thank you, Luke. Another question now. How much does invoice financing cost? Jamie?
Thanks, Sam. I'm going to have to be a bit on the fence here, I'm afraid, because it depends, basically. So I think really it just comes back to, as I was saying earlier on, is it's all down to what the funder perceives the risk to be within your debtor book. So, if you've got a track record of bad debts, if you've got long credit terms, typically, or high customer concentration, they're all things that will increase the rate. But just as a point of comparison, because it will be relevant to each business, you're looking at rates that will be cheaper than the likes of maybe your overdraft you're currently on, something like that. It's quite difficult to put a specific range, unfortunately, but that's the kind of area that you're looking at.
Excellent, thank you. We've had another one now. I've obtained a judgment against an individual debtor. What should I do next? The debt is only £600. Jack, I think that's one for you, please.
Thanks, Sam. So you've got £600 judgment against, I'm going to assume, a person with the use of the word individual debtor. First of all, congratulations on getting the judgment. It's not been an easy time to do that. Without copying Jamie, it depends. It depends on what you want to do next. Do you have a relationship with that debtor? Why do they owe you? How has that debt arisen? Obviously, it's not been challenged or it's been validated by the judgment. But what is your appetite to see that all the way through to what would almost certainly be a bankruptcy position? That's the threat that we can use to our advantage. If if we can open up a dialogue with that debtor. I think it's an interesting situation to find yourself in, because of the value at just £600, and any cost is going to be, you know, quickly eroded. You know, it's going to erode that value very quickly. So I think you know, as a starting point, test what we've been talking about today, and give us a call, and let's talk through the scenario, and see what we can do to take that forward with you.
Excellent, thank you, Jack. Questions are starting to come in a bit thick and fast now. We're going to go back to Luke for the next one. What does Bishop Fleming get out of offering Escalate?
Oh, good question. What did Bishop Fleming get out of it? Well, I think first of all, we partnered because we recognise across our client base that, you know, lots of, well, not just the client base, but across the firm, sort of generally, lots of clients will have problems recovering debts, and you know, ultimately we want our clients to be in as strong a position as possible. So if we could bring a solution to them that helped them, you know, address these types of problems, then it's a good added value service that we can introduce. We are a licensed partner firm. There are very few firms like ours across the country who are licensed partner firms, and the reason that we're licensed is to not only be able to offer this to our clients as a solution, but it's also because, again, coming back to the, you know, the premise behind Escalate, it's about trying to get the other side around a table initially, and about trying to, you know, look at the figures, and about doing a bit of a deal, if possible, you know, a deal that clearly works in your favour. And the reason we're involved is because, you know, as restructuring and insolvency people, we're sort of well versed on a, I guess, you know, on a sort of day-to-day basis. We have lots of these conversations in our general work. We're used to trying to, you know, come to sort of commercial settlement arrangements. So we're basically partnered for that reason. It's so that we can get involved in that initial work. If ultimately that initial phase of work doesn't yield a result for you, it's the claimant, then it flips back to the lawyers. They run the case as ordinary lawyers. I think the other thing just to mention on that as well is that because Bishop Fleming's got lots of different advisory services. So, for example, we'll do valuation advice on shareholdings. As a licensed partner firm, we can get involved during the course of a case that Escalate are running to, you know, provide expert advice on a shareholding valuation, for example. So lots of reasons that we can be involved. You're probably also wondering, you know, did Bishop Fleming get paid for this? We get paid by Escalate if we get involved, but our fees, like the lawyers, like the barristers, for example, they're only recoverable on on a successful outcome. So that's kind of how it works. I hope that answered the question. Thanks, Sam. Back to you.
Thank you. We've had a comment come in that I think is actually a really great point to make, that within the businesses themselves, there can often be conflicting opinions between credit control and senior managers. And I think this touches back on one of the points Hazel made at the beginning of her piece. It's really important to ensure that the credit controller is of a senior position within the business and has the tools available to be able to not only achieve what they want external to the business, but be able to achieve what they need to internal to the business to make sure those goals are aligned. Going back to a question we've had about companies trading in administration and how they can continue to trade, and I'll hand over to Jack for that one.
Okay, thank you, Sam. How long have you got? I mean, we could talk about trading administrations all day. I think the important thing to say, I think, at the start is that the insolvency regime is genuinely there to help situations where there is, you know, a mess, but that mess needs to be cleared up, and it needs to be cleared up in an orderly way, and it needs to be cleared up in such a way that maximum value gets back to those that have suffered. So if a business has reached a point of insolvency and extreme financial distress, a solution may well be to continue to trade that business to maximise the return to those that have suffered in that scenario. That could lead to a sale. It could also just lead to an orderly wind down, as was the case with Borders, actually, all those years ago. So they're allowed to incur additional debt to ensure, you know, they would only do that, or they should only do that if there is a reasonable prospect of increasing the return to creditors. So I completely understand why from outside of the profession, there are a number of things I think that go on that probably look, you know, suspicious or you're concerning or at least confusing. And what I would reiterate is that piece at the top is that the industry and the profession is there to help and to aid in situations of real distress, and actions are taken with the mindset of improving the position for everyone that is suffering. I hope that answers your question.
It's great, thank you, Jack. We've had another one that come in that I think is going to be relevant, especially going forward for many businesses, is I'm having problems collecting a retention on a construction contract. Is this something Bishop Fleming can help with? I'll go back to Luke for that one, please.
Yeah, we can most certainly help with it. I mean, construction is a sector where we see lots of bad debt issues. Jack and I are actually currently involved in the liquidation of a high-profile construction company that's had problems, cash flow problems of its own, because of a bad debt, a customer of theirs that went into administration. So we know firsthand, you know, it can have a really big impact on businesses. Can we help? Yes, we can. It's most certainly something that we can look at, you know, either through an Escalate type arrangement or with a different law firm. I mean, Escalate in particular, they've got experts within their network who they work with who focus, you know, specifically on construction. So they've got some very good firms that they work with. And again, if you need help around finalising accounts, chasing retentions, you know, whether there's arbitration, all that sort of stuff, it can all be looked at, you know, in a cost-effective and risk-free way through our relationship with Escalate, or, like I said, alternatively through you know, through different law firms that we work with. So we can definitely help you. And if you've got these sorts of problems, then feel free to let us know, and we'll chat to you about how we can help sort of further.
That's great, thank you, Luke. Just aware, as the time's getting on against us now, we did have a flurry of questions right near the end, so apologies if we haven't got around to your question, but do feel free to contact myself or any member of our team here, and we'll be more than happy to help. Hopefully that's been a really useful session for everybody, and just given a bit more background and useful tools and ways to help overcome those challenging debtors. And thank you everyone for joining us today.